Today, we're looking at a pretty aggressive bull case for NIO.
The one with that 945 price target?
That's the one. And the whole thesis really hinges on this big pivot to the mass market, with Onvo and Firefly.
Right, and it's all supposed to be cemented by that huge October delivery number, the 40,000 units.
Exactly. So let's dive in. The first thing that jumps out is that to elevate this from just an opinion to a robust investment analysis, it absolutely has to integrate and neutralize the counterarguments.
I see that too. The enthusiasm for the growth is there, but that whole super cycle idea, it feels a bit fragile on its own.
So that's the weakness.
It is. The document is purely a bull case. It completely omits the risks, the external threats, anything that could derail that valuation.
And for any serious investor, that's a huge red flag.
It is. An argument with no acknowledged counterpoints just lacks conviction.
So the suggestion here is pretty straightforward.
You need a dedicated risk assessment section. You have to build it in.
And the key is not just listing the risks, but
explaining why the company is positioned to actually overcome them. That's the critical part.
Okay, so let's get concrete. What would a good example look like in that section?
Well, for one, you have to address what happens if that 40,000 plus delivery number isn't stable. What if it drops off in November?
A false peak, essentially.
Exactly. And even more importantly, you have to analyze the competition risk. Say Tesla gets aggressive and cuts the Model Y price again.
And that's the perfect opportunity to bring in NIO's battery as a service model.
You got it. You use BaaS to show how that subscription ecosystem structurally shields their profitability from a price war. It proves you've thought through the downside, and that builds massive credibility.
That makes a lot of sense. Okay, let's pivot to the second point, which is really about the engine driving the entire valuation. The report relies so heavily on this promise of operating leverage, but the term is just kind of left hanging there.
It needs to be quantified to be credible, right? It can't just be a buzzword.
That's it. The weakness is the assumption that high volume will automatically, quote, drastically drop the loss per vehicle.
And right now that's based only on anticipating what analysts will say about Q3. It's speculative.
There's no financial roadmap in the piece itself.
So we need to operationalize the concept.
And the suggestion there is to translate that volume growth into specific, measurable financial targets.
Yes, targets that an investor can actually watch for in the upcoming earnings report to validate the thesis. A litmus test.
Okay, give me an example. What kind of target are we talking about?
I'd want to see a specific gross margin percentage target. What number do the sub-brands Onvo and Firefly need to hit to confirm this path to profitability is real?
A hard margin target.
Or you could flip it. Articulate the specific loss per vehicle figure the market needs to see it fall to.
So you're essentially giving the reader a checklist.
A verifiable checklist. That's what turns a hopeful story into a data-driven investment strategy.
So to recap, there are two crucial areas for improvement here.
Yep.
First, build credibility. You have to bring in those counterarguments and then actively neutralize them, using something like the BaaS model as your proof point.
And second, you have to quantify that core financial argument.
Exactly. Get specific with those margin or loss per vehicle targets. You have to move beyond hope and into verifiable metrics.
Focus on those measurable targets and the risk mitigation. That's what will convert this from a projection into a real thesis.
Refine your report based on these suggestions, and we encourage you to submit it back to us for a follow-up critique. Until next time.